Jagdharani Sampath-Kumar is a capital market expert with over 20 years of experience in the securities industry. She is currently pursuing her passion of spreading financial literacy to all, especially the working youth. Prior to becoming a consultant and trainer, she was an executive director at JP Morgan. Before that, Jagdharani spent over a decade at the National Stock Exchange of India in various roles such as Vice President, Head of Exchange Operations, CRM and Business Development, and more. She has successfully implemented multiple business projects and headed the market operations of various exchanges. Our warm welcome to Dharani. We are glad to have you present at the online Manipal Plus series. Before we start the session, I would like to request the audience to ask questions only in the Q&A tab. Also, to help us continue to make our programs better, we request you to please take the short survey at the end of this webinar. Over to you, Dharani.
Yeah, thanks. I think Manish has joined in. Manish, you want to speak a minute? Yasin, you want to introduce him for a second?
No, yes. So let me just take only a minute. My dear friends, hi, this is Manish Bansal. I'm part of the team. And I must tell you that this part of the money and the money-related aspects is something very close to my heart. For the last 25 years in the market, I have seen very educated people doing very nonsensical work with the money. And I truly believe if all of us work in a disciplined manner, 25 years, 30 years of working life, all of us can become $1 million guys. That's where it is. And we have to accomplish the financial freedom with civil responsibility. And that's where we are. All these institutions, MIIs are trying to facilitate, and we are trying to take that message to all of you. And that's where my amazing friends like Jagdharani and the Manipal entire team is working in that direction to get to that knowledge. So take full advantage of it. Jagdharani is a very close friend, an amazing human being, and an awesome speaker. So take full opportunity. Listen to her, ask questions, drill her down, so that you can learn and take something really meaningful from here. Thank you very much, Jagdharani, to all of you, and have a beautiful time. Thank you. I'll step out.
Thank you, Manish. Thank you.
Thank you. Thank you. See you. Bye. Bye.
Hi, team. Everybody can hear me well? Okay. So, I have a small request, Yasin. The Q&A, what happens is the questions starts piling up. All right. All these basic questions also remain. I find the chat easier. Would that be okay with you?
Yes, Dharani. Whatever is comfortable.
Yeah, I prefer the chat. So put in the questions, unless it is a very long question and you want to keep the data in the Q&A, put it. Otherwise, I keep asking questions. So you can answer me in the chat window. That way it's quickly responded. Okay, first things first, it's a Monday evening. The week is long and I think, okay, already questions. Ismail, my question is how to protect my capital if invested in small cap. How to hedge for small cap. We'll come back. Okay. Okay. All right, I'll come back. As we go along, we'll take up these questions, but it's a evening time. I'm sure all of you are hungry, even I'm hungry, but let's first get a bit of understanding of how do we manage our money, and then we'll move along, and hopefully we'll set a mood for the entire week. And good evening once again. My name is Jagdharani. Yasin has already introduced me. I have, just so that you feel comfortable, I have more than 25 years, or I should say 30 years of work experience, okay, out of which major portion was spent at NSE. Okay, Praharvishwaran, use the chat window because the questions pile up here, and I think it's at your end. Others are okay. I think your internet probably is an issue. See if you can, I don't know what else to do. Okay, so check your internet speed. Everybody else is saying it's okay. Sorry about that. But I think there's a recording. If you are not able to hear me properly, probably can listen to the recording. Okay, so we started with a lot of questions straight away. So we will try and address them as we go along. What are we going to talk about today? Today we're going to talk about financial planning, as in how do you manage your money, all right? So this program is actually sponsored by Bombay Stock Exchange of India. It's part of their, okay, wow. Purnima says, what is hedging, how to calculate? Array, wow. We'll talk about that as well. Keep it there. And okay, come back to, give me a few minutes. Let me set the mood for the session, then bombard me with the questions, all right? So Bombay Stock Exchange is sponsoring this program. It's part of their investor protection fund initiative. Exchanges, mutual funds are all supposed to spread the knowledge, and people like Manish's entity are the ones who actually do the groundwork. People like me are associated with the entities like Manish's firm. We are independent trainers. We try and pay it back, so to say, whatever we've learned in all these years. So the program is actually being conducted for BSE by SME Value Advisors. Manish has multiple organizations. Accelerated Mind is one of them. Value Advisor. He has, I think, multiple entities which are focused on financial markets. You just met him, so I won't spend too much time on that. His details are there just in case you want to reach him. Okay, so the session starts with some learnings out of a movie called One Idiot. I did that last session as well with one of your parallel teams. How many of you have seen this movie? Use the chat window to respond because it's not a question. I am asking you, Kristen. How many of you have seen this movie? I haven't seen it. I'm a Tamilian. I see very few Hindi movies. Yeah. So have you seen this movie? Have you seen this movie? One Idiot? Yes, no, maybe. Why are you all quite sudden? Okay, all in Q&A only, is it? No, all right. Even I, okay. Prahadishwaran has seen it. Fantastic. You are the first time. I've done this session many times, and you're the first person to have said that you watched this movie. Great. Very good. Excellent. Okay, everybody jumping into the Q&A only, is it? Nice. All right. The problem with Q&A is if I don't respond, it piles up and shows a pending question. Can I request you all to shift to the chat window? It's easier for me. That way, please go to the chat window. All right. All right. So I haven't seen the movie, but I'm just going to pick up a few learnings sort of it just brought up here. And I'm sure some of you are Hindi speaking participants. So what does that first sentence, Kacha Jabardasti hai means? Anyone? What does Kacha Jabardasti hai means? Hopefully I pronounced it correctly. Oh, chat window is disabled. All right, continue here, no problem. What does Kacha Jabardasti hai means? Anyone? You can unmute and speak as well if you want to. What does Kacha Jabardasti means? Anyone knows? Spending is more. Okay, spending is more. Okay, spending is more and no. Okay, don't worry about it. We'll stick to Q&A and I am watching it. Okay, so spendthrift. All right, thank you. All right, okay. What else? Spending is much more than expected. All right, great. So the thing is, I like to give real life examples. Here I was talking to my niece's grandfather, the other side, and they are in the age group where they're still learning. They're like early teens. They're not even teens. They are like 11 and 9. Okay. Now, each of us come with a certain personality. This is a fact, or what I have discerned over a period of time, that some behavioral things are what we are born with. Okay. Some of them we learn on the way. Now, there are good and not so good personalities. All of us carry with us. So one of the things is some of us are innately prudent in how we manage the money. Some of us are not. Now, so these two nieces, one of them understands to a large extent how she deals with money. The other one is thinks that money grows on tree so far. So whatever gift she gets in terms of money, she just wants to spend it on people, spend it away. She doesn't, the concept of saving hasn't yet, okay, chat is on, I think. Okay, now chat is on, so try the chat. All right, it's easier because in Q&A it keeps showing that it's unanswered. So that's kind of distressing for me. All right, okay, so the thing is, the problem is majority of us don't. So I was just talking to their grandfather. I said, yeah, I told him, bring up this concept that, you can create wealth in 2 ways. Okay. Ismail has a question. My question is how to protect my capital if invested in small cap, how to hedge for small cap. First of all, Ismail, you talk about hedging, etc., only if you are a large portfolio manager. If you're a retail investor like you and me, stop worrying about hedge. When you invest in stock market, it's for long term. And in the long term, as long as you have invested in good stocks, they will do well. Even if they are not doing well in the short term, they will do well in the long term. But small cap stocks by nature have a higher risk factor. So unless you understand the markets, unless you're a very good fundamental analyst, I would keep away from investing in small cap directly. If I want to have exposure in small caps, I would rather go to a mutual fund. All right. What is capital exchange and stock exchange? There's nothing called capital exchange. There's only something called stock exchange and derivatives exchange. There is no term, at least Prahadishwaran. This is the first time I'm hearing the term capital exchange. All right. I might be wrong. Suslon. Okay. Shubham has, if the situation becomes like Suslon Energy. Yeah. Capital market, stock market are pseudonyms. They are one and the same. They are not two different things. Okay. Now, Suslon and, okay, SIP versus lump sum. Can you guys hold on? I usually like questions. I like to conduct my sessions that way, but you're all going a little ahead of the situation. So we'll come to that just for a few minutes. I will ask questions. You guys answer. Okay. Let's hold on for a few minutes. Then I will let you guys ask me questions. So just to answer that one question on Suslon, I'm not talking about Suslon. Generally, when you invest in a stock, you don't invest in one single stock. Because there can be a situation where the company may not do well. Even the rest of the companies can get into trouble. What you then land up doing is distribute your investment on multiple stocks. Ideal portfolio, so to say, should have at least 20 to 30 stocks. That way you're diversifying your risk. But second part is, once you have invested in a stock, your job does not come to an end. You need to keep looking at the status of the company, not every day, on a periodic basis, on a quarterly basis. How is the stocks in your portfolio doing well? If you find that suddenly the company's performance is deteriorating, time comes for you to take a call, whether you want to be invested in the stock or exit out of it. So you don't wait for a disaster situation. You start taking a decision much, much ahead. That means if you're wanting to invest directly in the stock market, you must spend time analyzing stocks and be aware of what's happening to individual companies. But it's a time-consuming effort. Many times I advise people to go the mutual fund way because they do that job for you. Okay, Sachin says, I've been doing F&O trading, but I'm in net loss. How do I make consistent profit in F&O? Sachin, my feedback to you is, anytime you do trading, which is with a short-term perspective, there is always winners and losers. And it's my feedback is always, I tell people, look at long-term, be an investor, don't go into trading unless you're a professional trader. If you're a professional trader, then you spend your time analyzing technical analysis, understand options and futures, and still you might land up making loss. Okay, even the best of the guys may be making loss, Sachin. Okay, so if again simplifying it, but I'm telling you, if you're an option trader, if you're a buyer or the market is always skewed towards the seller of the option, not to the buyer of the option. And you don't do vanilla buying and selling of options. You basically look at creating strategies. Even the best strategies can come undone, etc., etc. And you will burn your fingers. By burning your fingers, you may learn something or you may not. If you are starting off the block without understanding the market, the first thing I'll tell you is go and learn a lot more about futures and options market, do some certifications, go for all these programs, start in a small way, do paper calculations instead of directly investing money, then you put your money. But personally, I advise people to go into investments and not trading. All right. I hope I answered your question, Sachin. All right. Coming back to the lessons in life are, look at, if you can create wealth in two ways. I haven't got the answer. You can create wealth in two ways. What are those two ways? How can you create wealth in two ways? You can create wealth in two ways. What are the two ways? Anyone? Investing and working and compounding. Okay. What else? Active and passive income. Then creating wealth I talked about. Okay. So here is an answer for all of you. And please follow that if you can. One is earning. Yes. Another is saving, or what I wanted to talk about is you can earn income and reduce your expenses. You can earn income and control your expenses. Controlling your expenses is also a way to grow your wealth. Have you thought about it? How many of you think before you spend? Have you thought about controlling your expenses? Is that one of the mantra which you follow in life? How many of you? Okay, earning and investing is one part, Rajini. You earn and you invest. Okay, the other thing is reduce your expenses to grow your wealth. Alex, think about it. You know, we can earn, invest, get dividend. Okay, hold on, guys. The thing is, we can always say that it's difficult to control expenses, but if you know, there's one more nugget I want to share with you. There is a term which is live below your means. Have you heard of the term live below your means? Have you heard of the term live below your means? Okay, so that's what we should all look at following. Minimalistic living helps us to grow our wealth. One is earn income and grow your wealth. Other is minimalistic living. Yes, controlling unnecessary expenses and buying only necessities of life will save more. Spend as and when it needs. Absolutely. So think through that. It has helped greatly for me. And it has, I've seen people who do the other way around and throw money around. Okay. So that's the first point. Second is, we buy things which are not required. You'd have to sell things which are required. And that's 100% fact of life. If you have never, okay. So which I say is, I've never invested apart from FD, will get help to start investing in stock market. I am afraid of losing money. Maybe I am. Okay. The easiest way to do is to start using mutual fund route to invest. And I will talk about it. All right. Listen to the session and we will see if you have got the point. So if you're buying things which you don't need it, you are definitely going to be in a situation, desperate situations. And I've seen it happening again and again and again. So remember that. Third point is people living on credit, creating worry. So anytime you take a loan, are loans free? When a bank gives you a loan, worst case, you take a loan from a money lender, are they free? Do you get money free? People lend you money free unless they're family. They don't, right? Money doesn't come free, right? So it comes with a cost, and the cost is very, very expensive. One, you pay interest. Second is, when you have outstanding loan, that's like a sword hanging on your head. So think before you ever take a loan, unless it's an emergency. Now, emergencies happen. Why do emergencies happen in life? Financial emergencies happen. Why? Why do financial emergencies happen? Why do they? Because of no savings, or more than that, Anurag, it's not about savings. It's about fear of uncertainty. Jaren, when we don't plan finances, absolutely, Avinash. If we don't plan, lack of planning is what leads to all the unnecessary, unexpected expenses, which leads you to go and take a loan, and then so on and so forth. Again, so since Yasin is sitting through both the sessions, and I don't want to bore her, so I'm going to tell you another analogy today about living on credit. Right in front of my house yeah, keeping some security finances during emergency. Yes, absolutely, Shubham. So right in front of my house, there is a small bungalow, I can call, and which is being taken care by a husband and wife. So they are middle aged. They're like in their 50s and 60s. Okay, children are quite astray. None of them. In fact, their son doesn't work. Also, this lady has got 7 different loans. She has borrowed money. Okay, she's living on borrowed money. She borrows money to get her son married, who doesn't even have a job. Next, she borrows money because the son has children and the children are not well, and so she borrows money. And so she keeps on borrowing, and because she's borrowed money, she has to work and pay the interest on the borrowed amount. She's not earning to pay the borrowed amount. She's earning to pay the interest on the borrowed amount. She's in a debt swamp. Okay, that's only an example. But in real life, there are lots of people, quite a few people who are in a debt trap. So don't get into the debt trap. Don't look at credit as a way to take care of your needs. If you can postpone something, postpone it. Okay. Spend time thinking about money and how you will deal with it. It's just absolutely important, because money doesn't grow on trees. Money doesn't keep flowing. You may be working today. How long do you think you guys will continue to work and earn a living? How long do you think you can continue to work and earn a living? Can it be perpetual? Until 45. Okay, Jason. Okay, Jason, are you in your 30s or something? 60 years, perfect. As long as we have good health, very good. Excellent answer. But till 60. But Shubham, do you want to work as long as you're healthy, or do you want to get off the bandwagon at some point of time? It's a very personal choice. So it's not like you're going to work forever. Even if you want to work forever, like Shubham says, sometimes no guarantee, right? Pandemic, even if you want to work, you may not have a job, or there is a retirement age, or okay, which I hold on. I need to spend around 1 crore, which is there in my dream. Okay, you mean to say you want to invest? Okay, Vijay, I don't give personal advice here. I'm just going to share a lot of thoughts with you here, and then the next step for you would be to read a little more and take the help of professional financial advisors. I'm not a financial advisor. I'm an educator. I'm a trainer. I'm just going to make you understand a few concepts here, okay? And listen to it. So don't look at taking credits unless it's extremely important. Spend time how you use your money. Future is not extrapolation of the past. Just because you're rich today doesn't mean you're rich tomorrow. This holds true for all the business people whose income can never be predicted. So as long as the money flows, everything goes into the business, and never think about their personal life, what happens if the business flops, etc. So never think that your past is same as your future. Future can be good or bad. So it's in your hand to ensure your future is safe. So that's why financial planning comes into picture. Then, like somebody asked, I have money in the FD, I want to invest, what do I do? Keeping money in a single type of investment is not a great idea. You actually distribute your wealth in multiple asset classes. Why? Because sometimes stock markets will do well, sometimes debt market will do well, sometimes real estate will do well. That sometimes is not some random stuff. It's to do with economic situations. And the economy is in boom, stock market will do well. When economy is in recession, debt funds will give you a better return. So it's good to have an asset allocation. Also, the last point is, there are multiple things you need to take care when you do a financial planning. One is, first step is to save. If you don't save money, there's nothing, no story, right? So have a habit of saving, and then you invest. How do you identify economy is doing good? I'll tell you, is it okay to only invest in unit trust because shares and all difficult to monitor? Absolutely, Alex. Don't call it unit trust. Talk about as mutual fund. Unit trust is one kind of mutual fund. Absolutely, perfectly all right. No need to go directly investing in stocks. You can get the same benefit. How do we identify economy is doing good? Look at the data which will be published. You look at your newspapers. They will talk about GDP growth rate. That tells you, is GDP shrinking or growing? Okay, GDP numbers are published. Then you talk about inflation numbers. Very high inflation means slowly economy is going to get impacted. Okay, so those are all the economic indicators which will keep coming. If there is a page in your newspaper which is focused on business, read it, try and understand it. If you don't understand some term, go online and go and search for the term, and you'll over a period of time get a hang of the whole stuff. All right. So continuing with the topic, so you have to invest your money, but you also have to look at risk management. They are two different things. So taking insurance, how many of you have life insurance here? How many of you have taken medical insurance, life insurance? You can just say yes, no. Medical insurance, yes. Okay, mutual funds are not expensive. I'll talk about it. It's not, okay. They charge you a fee, but it's okay. Term life, very good, excellent. If you have not taken a life insurance, time to look at it. If you are, especially if there are people dependent on your income, you need to look at life insurance, disability insurance, medical insurance. All right. And if you have a loan, like a housing loan, ensure that it is protected with the mortgage insurance, so that if there is any stoppage in your EMI for some unforeseen circumstances, that can help you, the insurance policies. So keep them in mind. Right. So, all right, let's move ahead. Once again, a lot of Okay, so Chetan asks, SIP versus lump sum, what to consider on initial stages of investing, or index fund best way to start? I would suggest look at SIP because slow and steady wins the race. Lump sum, there's all, especially if you're investing in equity funds, equity mutual funds, don't go for lump sum. Go for SIP, or there's another term called STP, systematic transfer plan. SIP is you are not having that much money. Every month you're saying something, or every quarter. STP is you have that money, but you don't want to put it at one shot into an equity fund because markets are choppy. They can go up and down. So what you do, you take the money, keep it in something called a debt fund or a liquid fund of that particular fund house, and then do something called systematic transfer plan. I will advise STP or SIP. Index funds are a great way to start because returns are very simple to understand, low transaction fee. I'm a big fan of index fund, and one of the category of index fund is called ETF, or exchange traded funds. I invest quite a big chunk on ETFs, which are on index, market index. Okay, Hanumant Raj, okay, he's just joined, I think. All right, no problem. Let's move ahead. Okay, guys, is that Livia? Okay, now I have a question. This is for Yasin. Is there a hard stop timing or something, Yasin? How long can we go
on? Do you mean
end time?
So the session is for 1.5 hours.
Okay.
Yeah.
Okay,
so yes, so we've kept some extra time. So 1 hour session, and we can have the rest of the time for Q&A if required.
Okay. So Rajini Kanta, you're asking under SIP. Okay. Under SIP. 1 second, guys. What is the portfolio we should choose from starting? Okay, if you're new to the thing, it depends on your age. If you're young enough, I would ask you to start with a large cap fund because it's less riskier. All right. Next question. What investment method will beat inflation or returns? Okay, excellent question. Okay, so I will stay there and answer this question. Since inflation is brought up, whenever you are making an investment, you have to look at creating a wealth which is better than inflation. If the return on your portfolio is less than inflation, that means your money is not growing as much as the inflation. That means you are in negative return. So there are only 3 asset classes which take care of inflation. One is stock market, second is real estate, third is gold. Stock markets beat inflation hands down. Gold is called inflation hedge. Basically, it will protect you against inflation. And real estate is inflation proof. In the sense, the rental income from a real estate will always be as good as the inflation number. So these are the 3 assets which are good investment tools to beat inflation, but doesn't mean that you keep them all in that because they're all growth assets. Sometimes you need a regular income as well. So you need to keep some of them in income bearing instruments. Okay. So moderate, large cap, or moderate or small cap if you are in 30s. If you're in your 30s, I would say there is a category called large and mid cap. That's a category I will advise. Okay, is volume of trades a factor to worry in ETFs? Absolutely, Chetan. You need to look at the liquidity of the ETF because if it's illiquid, the prices can be not so reflective of the reality. I have invested in equity and made 122% return in 3 years, but my index mutual fund is giving me only 35%. Ismail, I need to look at what you invested in. That could be random luck. If you have invested in one stock that did well, doesn't mean it will always give you that kind of a return. So I'm going to make a statement here, risk versus return, lower the risk. Why do you, Hanumat, I didn't understand. Why do you study? Oh, you're looking at this. Okay, I'll come to that, the presentation. All right, hold on, guys. So let's talk about risk versus return. Lower the risk, lower the return, higher the risk, higher the return. So taking that example of your investment, something which has given you a very high return can also create a high risk. So right now it looks good, suddenly it can tank. So today, to take an example, Power Grid, price fell by 10%, 8%. Stock price in 1 day fell by 8%, but it recovered. That's a different matter. So that risk exists. Whereas overall market fell by 1.3%, that particular stock crashed by 9%. See, that's what I call as risk versus return. The index fund is a diversified portfolio. Return may be moderate, but risk is also lower. If you're investing in a small cap or a single stock, it might suddenly give a very good return, but it can also crash the same day. So keep that in mind. All right. Now coming back to ETFs of index, how risky compared to index mutual fund? They are one and the same, Chetan. Only the methodology of your exposure is like if you are investing in an index mutual fund, you go to the fund house, buy it online or through your distributor. Whereas if you're investing in an index ETF, you can buy and sell it just like a stock. It's also the same nature, but it's through a stock exchange platform. And second thing is index fund, when you invest in an index fund, it takes end of day price, whereas ETFs you can buy during the day latest price also. Okay, so can you put light on momentum investing means only investing in alpha 10? Okay, so too many questions. Okay, so in my first time in my life, I'm going to tell you guys, hold your horses. Okay, just hold on with your questions for a few minutes. Let us move ahead with this, and then we'll take some of these very specific questions at the end of it. Yasin, this is the first time in my life where I've told people to stop the questions. Let's move ahead with the session, all right? Otherwise, yeah. So just hold on. Yes, just hold on for those kind of questions which are not in the slide. We will come to it. No, it's okay. No, I don't want to mute. I'm just telling, I'm sure all of you understand. All right. Right. So now some questions, because I'm going to keep asking questions. I want answers for it. Oh, I'm wrong. Ma'am, do you think markets are receding into a slump due to the oncoming recession, dollar rupee at all-time high, and a whole lot of other stuff, Satyam? It might be going towards so-called bear phase, but I'm still watching it. I'm not 100% sure. India is doing better than other countries because we are not hit by recession, but our markets are also correcting. Okay, my suggestion is don't wait for the market to fall completely. Keep buying in small chunks and keep averaging your value. Okay, now here is a rule. Okay, I'll finish one slide and then I'll take questions. All right. Unless I ask questions, you guys answer. So just hold your questions. So some of the questions which we want to ask is, what is this whole business about financial planning? Why should we do it? Simple. We all study because we want to work. Why do we want to work? We want to earn. And why are we earning? Because we want to spend. Now, if you keep doing this, it's like a vicious circle, right? You earn, you spend, you earn, you spend. Then one day you stop earning. Then you're in deep trouble. So that is why you need to have something called a financial planning so that you take care of this vicious circle. So this is for a little bit of a junior team. You're all well versed, but I'll still talk about it. If somebody tells you that I'll give you a check and I'll take care of all your expenses, do what you want. Now I'm going to ask you all so you can respond. What would you do with that? What would you do with your life? If I tell you, stop, you don't worry about your salary, it's okay. Okay. How can we earn monthly 4 to 5%? Okay, stop, Rudranjan. I am not teaching FNO here. I'm not teaching trading strategies. I'm talking about financial planning. So hold the questions towards it. Even if I understand options and I understand option strategies, I'm not going to train you guys on that. Okay, come back to the basic question. If I pay you every month, whatever is your salary, I say, stop worrying about your salary. What would you guys want to do with your life? What would you travel? Very good, Alex. Thank you. What about the others? What else would you want to do with your life? Enjoy freedom. I want to build 1,000 crore capital to pass on next generation. 1,000 crore capital. I don't know where you got that number. Okay. Remember, dream to fulfill, build a company. I will invest. Very good. Okay. So maintain a good health. Excellent. I'll do journalism. Fantastic. See, all of us have some ambitions. Build a startup, explore the world. Very good. Invest in real estate. All right. Okay. So hold on. I got enough answers. I'm going to talk about a couple of points here. One, someone who's talking about earning 1,000 crores and giving to the next generation. Always, it's better to have money to the extent we need. The extent we need. Anything beyond that, not worth it. Because money, it is not the best of the things to always have. Okay, you need enough and a little bit of cushion. Anything beyond that, it comes with this whole set of headaches. Not at all worth it. Believe me, this is what all the guys, the very big guys who earn, then they start doing philanthropy. It's okay. Don't chase money. Chase goals. Chase something which you want to achieve, but not money. Money should be the byproduct. That should not be a primary product. Second thing is, yes, we can all do what we love to do. You can do it provided you have planned your life well. So you want to get off the bandwagon at 40, 45, 46, ensure how much money you need to have in your hand to take care of your basic necessities. And there are these, what we call as retirement corpus calculators. How much money do you guys think? I won't say that. I won't say, okay, someone is saying, isn't your investment excess? Not really. So that's where the concept of retirement planning comes into picture. Like you all said, you all will be working maybe up to 45, 47, 60, max 60, because after that they tell you to go home. But how long do you think we will live? At 60, we'll not stop living, right? We'll continue to live. And how long do you think we'll live? Not enough, Jason. 1 crore is not sufficient, and I will talk about it. So from 60, how long do you think you will live for? Till 70, 80? What is the expected life term? How long do you think? 75 to 80. Average life expectancy is 70, but people live to 80, 85, 90. That's like taken for granted. So from 60 to 85, 25 years you have ahead of you where there is no source of income. So that is why you need to save and invest. You can save, keep some money aside to take care of it. But will that be enough? No, because inflation comes into picture. Today, what is 1 lakh is not what all you can buy with 1 lakh today will not be the same after 10 years, because 1 lakh will look like nothing. Why? Because of cost of living going up due to inflation. That is why you need to do something. That is why you need to invest your money and earn income or earn return on it, which should be better than inflation, so that the same amount of money will be enough post-retirement. Because if you keep growing as inflation goes up, this will also grow better than inflation, so you'll have enough money. So it's not an excess. You are creating a retirement corpus to take care of your retirement life. Okay. So again, my principles doesn't have to be your life goals. Okay. I'm just sharing some, because I've just gone closer to retirement and I have seen some things in life, and I feel, this is my opinion, that chasing money, we miss out enjoying life. We must work hard, we must earn, but money should not be the goal. Money should not be the only goal. We must create wealth to take care of retirement, but how much you can do that, again, 1 crore is not sufficient. Like I said, there are these retirement calculators which will do that for you for free. You put your current age, you tell your retirement age, and you say your life expectancy, how long do you think you live, and it'll ask you how much are you spending now, and then it'll also ask you what is the return you're expecting on your investment. If you put all these numbers, it'll turn out a figure and tell you how much you should have as a retirement corpus. Second thing, it'll tell you how much should you save and invest to reach the retirement corpus. Thank you, Vijay. Always listen to your heart. It will also tell you what you call as intuition. Your heart will tell you what is right and wrong. 14.2 crores looks too big, Ismail, unless you're in your 20s and unless you're spending like 2 lakhs, 3 lakhs per month. I don't know how you arrived at it. An average nuclear family with 2 children, the person in their early 40s, spending around 60,000-70,000 rupees per month, a retirement corpus of 5 to 6 crores or maybe 7 crores would be good enough. For that to achieve, probably around 50,000 per month, 60,000 per month, save and invest could probably help you to reach it. Okay, but I'm just, it depends on your spending pattern. I agree. But I'm just giving you a rough number. Just go and put all these details and find out how much you should have in your hand. Okay, so money doesn't come free like this. You need to create it. So that is why nobody gives you free money. So you got to start creating your own financial planning, decide how much is your earnings, how much you're spending, how much you should save, how much you should have for your retirement, blah, blah. But let me ask you a question. Is retirement is the only financial goal? Is retirement is only financial goal in life? Or are there other goals in life? What else do you need money for? World tour, health, house, absolutely. I like it. World tour, very good. Health, house, children's education if you're married and you have children's, education. Okay, there are many more. Explore passion and interest. Yeah, so for each of the, okay, now for the basic needs that you spend. But when you do financial planning, you're planning for certain goals. Now, goals have to be smart. That means it has to be specific, measurable, achievable, time bound, etc., etc. Okay. So you can't have a very wish statement and say that's my goal. If you say I want to buy a house, you have to say when do you want to buy a house? How much is where do you want where you want the house to be, and how much does it cost today? If you have all this information, you can arrive at a realistic amount what you need towards the financial goal. So every financial goal has to be calculated and arrived at, and you have to define the details. And goals can be short term, medium term, and long term. So each category of goal will require different kind of investment strategy. So think through that. How many of you here? Now my question to you all: how many of you actually have created your own financial goals and recorded it, written it down, put it in an Excel sheet types? How many of you have created? Okay, very good, Jason. Not it. Okay, very good, Anurag. Super. All right. So I think some of the messages are private. So I'm sorry, I'm reading out the names. I will stop doing that. But the point is, if you don't have it, create it, because that will give you a clarity. Otherwise, you're running into the something, and then one fine day you'll be shocked. Where am I? So create your financial goals. Okay, so when somebody says created but doesn't work out in mutual fund planning to invest in equity, as you said, to diversify. Okay, I'm not sure, but anyway, good point. All right, let me continue. Now, the other points are different kinds of income have different tax structures. The kind of income, like if you're an employed person, your tax structure is different. If you're a business person, your tax structure is slightly. You can write up a whole lot of stuff if you're a businessman. And if you are earning income through fixed deposit, you have to pay tax on the interest earned, irrespective of. One second, guys. 1 second. Okay. So coming back to, so let us say some of you are keeping your money in fixed deposit, all your savings. What is that you're facing there is that you may not need the interest income, but you will still be forced to pay tax on that. How much? It depends. If you're in the bracket of 30%, you will pay 30% tax on that. Doesn't make sense, right? One. So tax implications. Second part is, if you earn money out of your FD, what's the current FD rate? Anybody tell me what's the current fixed deposit rate? What is the FD rate now? 5.5. What is the current inflation number? What's the inflation number? 7%, right? Around 6.5 to 7%. See, very clearly you see in FD rate is much lower than the inflation. So it is not beating the inflation. Worse, you have to pay tax on that. So post-tax return will be much, much lower than the inflation. So FD is not a sensible way to invest for long-term goals. But FD is the right way to keep your money if in case your goal is like within 1 year. Why? I say fixed deposit is a good way to keep your money if your goal is like 1 year, 2 years. Why am I saying that? Why am I saying that? Why am I saying it's a good way to keep your money in, to protect capital? Absolutely, because you don't want to be, your goal is clear, it's going to happen right now, and then you find that you put it in stock market, everything is gone for a short period of time. The long term, it will improve. So that's a good point. So remember, so whenever you're investing, these things matter. What is fixed capital? What is the question? Get better interest than bank savings return of 4%. Fixed capital, there's nothing called fixed capital here. I don't know what you're talking about. I'm sorry. Okay, coming back to it. So different kinds of incomes and different kind of investment have different tax structures. So keep that in mind when you're making your investments. Always remember post-tax earnings are important. Like I said, FD will be very inefficient. If you're keeping your money towards your retirement and fixed deposit, you're going to be a loser in the long term. Now, this one lesson, if nothing else, please carry that. I didn't say it. It is supposed to be said by Mr. Warren Buffett, but it's very basic fundamental logic. I'm just going to make a small change here. Normally, you earn money, you spend. If something is left, then that you call as savings. How many of you do that? Whatever is left out beyond your spending, you call it as savings. How many of you do that? If you do that, say yes. If you don't, okay. So that's like a very lazy way to do it, okay? Now, the ideal or the right way to do is, salary hits your bank account, you spend on your basic necessities, okay? You spend on your basic necessities. That cannot be done away with. Then, okay, very good, Chetan. Then you, what percentage of money should we keep in the unforeseen? I'm coming to, okay, excellent question. So spend on basic necessities, decide a percentage which you will save towards your goals, then balance you can spend. How much you have to keep aside towards your goal? Like I said, you can calculate using the calculators, online calculators. But if I have to give you a thumb rule, 30% of your income usually is spent on your basic necessities. So whatever your current expense, equivalent you keep aside towards your retirement. That means another 30% can go into savings. 20% plus will go on taxation. So balance left out maybe 20% to 15%, which you can spend on your etc. etc. So Jason has given a number 30, 50, 10. Very good. I think people are able to respond only to hosts and panelists and not to the participants. I don't know why it is. I think setting is done that way. Yeah, 50, 30, 20, there are a whole lot of rules. Now, the other important stuff is keep some amount aside as emergency corpus. How much should be emergency corpus? Earlier, the trend used to be 6 months of your salary. But with the pandemic, it is now, yes, at least 1 year salary as an emergency corpus, and which should always be kept in a capital protected one like FD or something like that. Another question, Prahadishwan, everybody use the option of to everyone so that people can, others can read your question as well. What is the relation between income and expenditure? Okay, I'm finding all your questions very difficult to understand. Income and relationship between income and expenditure. I'm saying basic expenditure should not be more than 30% of your income unless you're just started your career. Then maybe 70% will be expenditure, but typically 30% of your income tends to be your expenditure. Basic expenditure. Rest of them, if you spend, it's like, thank you, Ismail. Income is input, expenditure is output. Thank you. That's a very interesting way to define it. Okay, now I'm moving on. Okay, so this is one lesson. Invest to build wealth. Okay, this is again, okay. So now, just because you saved your money does not equal to wealth. Why? Because of inflation. You need to invest them prudently so that it grows. Okay, now, what is building asset? Everything can be called as an asset. Is a car an asset? Is a car an asset? No, right? If you look at your balance sheet, if any of your commerce students, in the balance sheet, a vehicle is shown as an asset, but it's called as a depreciating asset. Okay, it's not a liability unless you've taken a loan from the bank. It's still an asset, but it's a depreciating asset. Absolutely, Vijay. It's a depreciating asset. Okay, so when you're spending money to buy an asset which is a growing asset, like a house or a stock, or gold, etc., etc. Absolutely. So think through that. So there are again asset allocation is important. Flat will come and appreciation asset. So much, Shekhar, a very good question, and I will spend a minute on that. When you talk about a house, it's sitting on a land, whether it's a house or a flat. Okay, Now the land is an appreciating asset. The building is a depreciating asset. Okay, so because over a period of time the building will start crumbling. So when you buy a flat, you have an ownership to the land on which it sits to that magnitude. So that's what the value is, not the construction which is happening there. All right, so the house will probably 15 years, 20 years, you may have to demolish and redo it. It's the land which is appreciating. Okay, so that's one. So now I'm going to give you again a very interesting thumb rule here. You need to do an asset allocation when you are investing to create wealth. And now what kind of distribution you should have when you talk about asset allocation is the thumb rule says, remember I said only 3 kinds of assets are inflation beating: stocks, gold, and real estate. Real estate is a very illiquid asset. Okay, if you want to sell it, it's not going to be easy to sell. So don't park all your money in real estate. I keep talking about one of my examples. I have a piece of land which is near a beach. Yes, absolutely, Rajnikant, I don't know if it's a male or a female here. Yes, it's better to invest in a land rather than an apartment. But again, it depends in which place you are in. I'm going to talk about real estate investment. Yeah, wait. So I have a piece of land which is near the beachfront. On paper, I invested around 10 lakhs, 15 years back or something. On paper, it is today worth 1.15 crores, so to say. It can even be, if I'm being very greedy, I can even say 2 crores. But the point is, can I sell it? Very difficult to find a buyer. Okay, so the bottom line is illiquidity is the biggest headache of a real estate, especially if you think that it's a buyer's market, it's not a seller's market. All right, and you're depending on the brokers. All right. Okay, Prahadishwar, you must hold on to questions which are slightly out of the context for current discussion. Okay, so coming back to it, so the thumb rule for your asset allocation should be stocks are the most liquid ones, by the way. So either directly investing in stocks or through mutual fund, doesn't matter. 100 minus your age should be your exposure to equities. So if you're like 40 years old, not more than 60% of your savings can go into equity. Balance 40% you divide between income bearing instruments like fixed deposit, debt funds, or bonds, public provident fund, etc., etc. 10% maybe in gold, and some portion of it is real estate. So this is the thumb rule. And as you keep growing older, you will keep reassigning the asset allocation. All right. So remember that, but this is workable for the long-term financial goals. If your goal is short-term, there is nothing called asset allocation. If your goal is 1 year down the line, you don't start allocating assets to a little bit equity here. You put it in a single asset class because you need the capital to be protected. All right. Got that, guys? Suddenly you all went quiet. Are you all turned hungry or something? You're feeling hungry? Okay. Yeah, hungry. Okay, that's an honest response. How to start building? Okay, I'll repeat. Somebody wants it to be repeated. When you are saved your money, you're saving towards your goals. Fixed asset, Paradishan, I think you're keeping a textbook and reading out points from there. I'm not going to respond because I'm just getting kind of distracted from the core topic here. All right, so let me go back and repeat. So you have financial goals. Some of them are short, medium, and long-term goals. So if it's a long-term goal, you do asset allocation. Medium and long-term goals, you can look at asset allocation. So 100 minus your age is what you will invest in stocks, because stocks are the most liquid and give the highest return, but they are risky. So 100 minus your age is a percentage of your savings which can go into stock markets, either directly or through mutual funds. Balance percentage can be distributed between income-bearing instruments like fixed deposit, public provident fund, or debt funds, or bonds, and a bit in gold and some in real estate. That rule will help you to create an ideal distribution of your wealth. Asset allocation. Am I making sense? Is that clear? Very good. Now let's move ahead. So these are the asset classes you can look at. 1 second. Okay. Asset allocation is important, which is what I talked about. Oh, 1 second, it's gone to the next one. Okay, some more questions there. Okay, the S is the answer. Okay, all right, wait. Okay, so asset allocation to happen based on your cash flow position and financial goals. Like I said, short-term goals, you don't start doing asset allocation. Real estate, does that include the house I'm staying in? Absolutely. The house you're living in is your investment anyway, Alex. Just because you're living in doesn't take it away from investment. If you didn't have a house, you would have paid rent, right? So that's what you saved on. So your house is actually earning something for you. No. I meant real estate. Even the house you own is an investment. In dire straits, you can sell the house and take care of yourself, right? So that's an investment. The rent is equal to which rent you hadn't paid because you're living in your own house is the earning from the house anyway, isn't it? Welcome. Okay. Then understand the asset profile based on the liquidity, ease, taxability, legality, etc. Like I said, I can put money in real estate because it's supposed to be beating inflation, but then it's so illiquid. So if I need a money in a hurry, real estate is not the one. Okay, Prahadishwaran, I'm going to ask Yasin to give you an award for asking the most questions for which I don't have answers. I've never heard of the term fake estate. Okay, I've never heard of the term fake estate. Lots of interesting terminologies you're dropping there. Put a financial plan in place and follow that in a disciplined manner to become rich. Absolutely no doubts about it. This is what you all have to do when you go back home if you don't have a financial plan. Now, this is another lesson in life. Compounding is magical. What does it mean? That the earlier you save and invest, your money grows faster because of the effect of compounding. Okay, someone asked, car liability. Yes, absolutely. In some sense, I talked about balance sheet concept where car is shown on the asset side because it still has some value. Even when you sell, it might not give you 100%, but it has some value. That's why car is shown on the asset side. That was only a technical explanation. Coming back to compounding, when you keep a money in a bank for 10 years, you earn much more than if you keep it only for 5 years. Because interest which you earn is again earning some more interest. So that's called compounding. When you put a money in a fixed deposit, if they pay you quarterly interest and you take the money away, rate will be lesser than if you compound it annually, etc. So both compounding, how does it work in mutual fund in the sense? Okay, somebody has put a very long statement. Okay, I'm not going to read that. So I'm just going to, he's only making his own statement there. So compounding is a concept that if you are invested in a stock or a compounding works, let's say if you invest in a bond, the interest, if you don't take it away, again earns further interest on that. So it gets compounded. In a stock market, how does it compounding happens? Because the company keeps growing, right? They make profit. And so the business grows. The business growth may be paid back to you as dividend, or it may be showing us a higher net worth in the balance sheet. So that's how compounding works in stock markets also. So earlier you save and invest, higher is your, okay, now, okay. All right, don't make such paragraph statements. Put chat window for questions and don't write paragraphs there, okay? Now, compounding is called as the eighth wonder because there are no eight wonders. Because just to give an example, if someone who saves and invests today versus someone who delays it by 3 years, the one who's doing it today will be in a better position than the one who's doing it after 3 years, because in 3 years, return can be as less as 35%, just random number. Ismail, you're asking the question again. I responded by saying that when you're investing in a mutual fund, they in turn invest in stocks, shares, etc. Those companies start making profit and that grows, etc. Okay, there's a question here. Is it correct decision to go for buying a property which is 100 times? Okay, fine. I'm going to stop answering the questions. As somebody said, hold the questions, guys. There are only a few more slides. Then I'll take one question at a time because they're throwing away and I'm not able to see that. Maybe at the time we'll do a Q&A part of it. Okay, just hold on all your chats now. Compounding helps you. The earlier you save, higher your wealth. So don't delay your investment decisions. Start doing it today. Okay, let's look at what else is there. Now, if you're dealing in stock market directly, these are requirements from the Bombay Stock Exchange that we educate you about it. Only invest through registered brokers. Don't go through. Yeah, thanks very much, Yasin. Yep. So don't go through unknown people for investing in stocks. When you invest in stock markets, ask for a contract note. It will come by email. If you don't receive your contract note, talk to your broker about it because that's your legal document. If you have a problem with your broker, you need to be able to produce a contract note and go to the stock exchange, SEBI, etc., etc. Don't go by market rumors, hot tips, doesn't help you. All right. When you're investing in the market, always do a fundamental analysis. Look at the balance sheet, P&L account, the industry, economy before you invest in the market. Don't go by announcements like fantastic results, blah, 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 because by the time the news hits, okay, thank you, Satyam. So why am I teaching you on financial planning here? You need to keep Soma Shekhar. They will send you by email. Very good, Satyam. It helps you, you get it by email, you store a copy of it because if ever you have a problem, you can use the contract note to take it up with authorities. Don't go by announcements of fantastic results. You do your research and penny stocks, be careful. Penny stock means anything which is less than 10 rupee, very low priced, they are low priced for a reason. Right? And whenever stock suddenly starts gyrating, be careful because either there is some kind of a rumor, manipulation, whatever it is, be aware of all those stuff. All right. Don't go by advice and tip. Do your own research. Pay your broker only by check or DD. No cash payments is not allowed. Okay. there's nothing. What are the rules of the stock market? That's a very open-ended question, Anand. I cannot answer such questions. I'm going to now come to Q&A in a minute. I'm going to talk about only a couple of more slides, then we go into Q&A. I think that's more convenient. Some checklists for you guys. Ensure that you have a life insurance policy. Term policy is the best way to do it. If you don't have a health insurance, ensure that you have adequate health insurance. You can use any app. Zerodha is a registered stockbroker. Grow also will be a stockbroker. So you can choose whichever you want. They're online, so it's much helpful. They're all called as discount brokers because their brokerage fees are much lower. Ensure that you have a health insurance. There are insurance policies called disability insurance policies. So if you are the breadwinner, sole breadwinner, good to have these kind of insurance policies under your belt. Look at investment. Like I said, decide your goals, short-term, medium-term, and long-term goals. Based on your goals, take your investment decisions. Your goals can be child education, marriage, retirement planning, buying a house, etc., etc. All right. So rest are only some sayings. Like Mr. Charlie Munger said, as long as you don't do any nonsense with your money, you would end up becoming rich if you are disciplined and patient. These are 2 points. Okay. If you keep a long-term perspective, yes, death, we don't call it as death insurance, Jason. We call it as life insurance. All right. Got. Yeah. So don't do anything. Don't invest. Don't put your money in things which you don't understand. Right? Like how many of you have how many of you put your money in cryptos? How many of you played around in cryptos? Do you all understand what it does? Do you guys know how? Yeah, little bit. If you know a little bit and you put your money, that's what yeah, kind of did the research. Okay, now read this again. If you, as long as you don't do any nonsense with your money, you would end up becoming rich if you're disciplined and patient. Basically, the story comes back to hare and tortoise. Okay, who won the race finally? Hare or the tortoise? Be the tortoise. Don't turn into a hare, because in the short term you might look like you are doing some great stuff. In the long term, you might land up being a loser. So be like the tortoise, not the hare. Okay, you guys know the story, right? Hare and tortoise. Yeah, somebody lost 70K in crypto. Okay, just watch out for it. I don't know what Solana is. What is that Solana? Joel, what is Solana? It's a coin. See, be careful, guys. Be careful. It's like I tell my very young niece. She accepted friend request on Insta from people whom she didn't know. She's very young. Okay. Same way, you don't do friends. You don't make friends with strangers, right? Similarly, you don't buy things which you don't understand, right? You won't put your money in things which you don't have a clue about. Be careful. All right. Next one. Right thing to do in life is to do the right things. Be very principled. You know, it's very convenient. When you follow the rules, you know, no headaches. So second is innately, it's morally you have to do the right thing. Okay. It is not at all safe, Muhak. That's what I said. Muhak says there is no regulations in crypto in our country. Don't think it's not at all safe. I wouldn't put my money there. All right. Last one, only one more saying, and then we go to Q&A. It makes many good deeds to build a reputation. One mistake and your reputation can be gone. And we keep saying social media can finish you in a second. Okay. So ensure that you are careful with what you do. Wealth is just not money. It talks your physical health, mental health, financial, intellectual wealth. That means keep learning. Spiritual wealth, social wealth, all put together becomes your holistic wealth. So just don't chase money alone. If you have lots of money, I actually give the example of Apple, the Apple man. Who is that guy? Jobs. Where is he now? Where is Steve Jobs now? Dead. What happened to him? In a grave, right? What happened to him? Not stress. He had cancer. Not stress, not depression. He had health issues. He had cancer, pancreatic cancer. All the wealth in the world couldn't cure him. Okay. So remember, health is important. Mental and physical health. Money is required, absolutely required. That's why I'm talking about financial planning. But money is not the focus. Wealth is the focus. Okay. So all kinds of wealth have to be taken into account. Health is wealth, absolutely. Yeah. All right. So then we come to Q&A. I think some books, I think you guys read a lot. So these are 2 books, Rich Dad, Poor Dad, Money Journey, Mad Money Journey, etc., etc. Kindly guide us, SIP related guidance to generate more. You haven't done planning. How can they do? Alex, okay. 50 who haven't done planning. Okay. Okay. So many questions. How to do? Okay.
Dharini, can I request you to just have a quick look at the Q&A questions also?
I'm going to go there. That's what I wanted to do. Okay, guys, we'll shift to Q&A in a minute. Okay, so people are suggesting some good books. You can check that also. So keep reading. So whoever has suggested there, keep reading up. Knowledge is power. And if you want a certificate for this, you can go to this website, acceleratedmind.com, and you can download your certificates. Wow, interesting. Lots of book recommendations are coming there. All right. And if anyone who's still a student and you're looking for an internship, they provide you Accelerated Minds, provide you a 2-month internship also. This is the contact details, right? Okay, Intelligent Investor, absolutely. That's one of the good books. All right, guys, note it down. Now my session ends, and I'm going to move to the Q&A, and so no more chat window, okay? I'm going to move to the Q&A side. 1 second. Where did it? 1 second, guys. Okay, now let's move to Q&A, okay? Okay, how to protect my capital if invested, that I've done. What is hedging? We will get any certificate? Yes, Shubham, that question is answered. What is this answer live? Yes, you will get a certificate out of that. How do we calculate hedging? Okay, I'll skip that question. I'll come back to it. Okay, so now
we have 2 questions from Pradeshwaran, basically on what is the difference between capital exchange and stock exchange, and the other on fixed and non-fixed assets. I know these are basic questions, but if you could
not basic, Yasin, not basic. They are not questions. That's why I'm not answering them. There's
Okay,
nothing capital exchange. So I just told that time itself. There is only a stock exchange. There's nothing called capital exchange. Okay. So some of the terminologies, I don't know where he's turning them out from. Okay. So like, real estate and fake estate, I haven't heard terms like that. I can't answer that. Okay. Ismail says, can you put some light on momentum investing, alpha 10 stocks? Okay. See, momentum investing, alpha 10 stocks, these are all looking at short-term trading patterns, basically looking at technical analysis and stuff, which is on momentum investing. If you talk about alpha 10 stocks, that means you look at see, okay, so if I have to talk about alpha 10 stocks, but first I have to talk about what we call as portfolio theory, which basically says that, okay, I will bring in Jason in a second, okay, just hold on a minute. So if you want to reduce your risk in investment, you need to diversify your portfolio so that multiple stocks help you to reduce the risk from one stock not doing well, etc. That's like the theory says you should have at least 25 to 30 stocks in your portfolio. All right. So, but diversification also reduces the return to that extent. So when you say alpha 10 stocks, you reduce the number of stocks in your portfolio so that you can generate a better return. The higher return is called alpha. All right. Now, next one, how to take home loan. Is there any good way to take it and make it free with some SIP trick? Wow. Okay. So, all right. I mean, you just go to a decent scheduled bank and they will ask you your status, financial status, and they will evaluate your home loan eligibility and they'll give it to you. How to make it free with some SIP trick? That's very, very complex question. But if I clearly understand it, what you're trying to say is on one side, I take a loan. On the other side, I make some investments. If that's what you're talking about, what people do is something called, there is a tax arbitrage possibilities. When you take a housing loan, you get tax benefit under Section 80C and interest eligibility under Section 24, so that you reduce your tax part of it. So you take the loan for buying a house, enjoy the tax benefit, equivalent amount or to your whatever money you are saving there can go into investment in mutual funds. So both ways, instead of directly buying a house out of your money, that money you invest in mutual funds, take a loan, and the SIP will grow. On the other hand, you also get tax benefit. So that's what probably people do. Okay, Hiresh says, how would you consider SIP in MF as a secure move to save your money? There's nothing called security. Okay, I'm going to repeat again. 1 second. What is this? On back testing, the momentum investing in alpha 10 stocks show greater return compared to mutual fund. Ismail, you are comparing. Okay, guys, all shift to the Q&A. Okay, some questions are still flowing in the chat window. So I'm answering in the Q&A now. So Ismail, short term, it might look like it is providing you better return, but don't compare short-term investment with mutual fund, which is long-term investments. The momentum investment is only for a short period of time. You earn some profit, you have to reinvest. The reinvested money may either give you a profit or a loss. So who knows? All right. So don't compare that with a mutual fund. They are two different ball games. One is trading, another is investment. All right. Next, Alex. Okay, Alex, what is that you're repeating? But for older people, how should they start to invest? Okay, sorry, I'll answer that. There is nothing called it's too late. It's better late than never. Only thing is, as you grow older, risk-taking capability comes down. Why? Because that's the only source of your income. You cannot take too much risk in stock markets, especially your parents. If they are depending on that for their regular income, they can't expose it to stock markets because stock markets can be in short term very volatile. So they can still have smaller percentage exposure to equity mutual funds. but they must secure their monthly expenses. If that's what they're looking at, they can look at buying what I would call as an annuity plan, not the entire amount. How much ever is the monthly expenses, towards that they can buy annuity plan. Annuity plans advantage is that they give you same amount forever. If you have taken a perpetual annuity till your death, it will give you the same income every month, every quarter, etc. So some part of it can be going into annuity for the regular income. And then if they are above 60, there are advantages. There are senior citizen schemes which pay a better rate of interest than of FD. Smaller portion, maybe 10 to 20%, maybe 20%. I don't know your full financial status to give you advice. I don't even want advice. All I'm saying is they can still have some exposure to equity. It's all right, but not very high. All right. But income generation, it can be through there's things like RBI floating rate bonds. Then there are annuity plans. They should be looking at those. Are mutual funds safe? High risk, high return? Ujjwal, high risk, high return depends. If you are investing in a mutual fund which is equity oriented, it's high risk, high return. If you're investing in a mutual fund which is investing in gold, it will give you a return similar to gold. If you're investing in a mutual fund which is investing in a debt fund, it is not high risk. It is moderate risk, moderate return. So it's a type of mutual fund you're going to invest in. All right. Sachin says, could you please suggest where to attend some good certificate course on F&O trading? Sachin, there are lots of these certification courses which are available in NSC, BSc academies, so you can go and check that out. Okay, who are debtors and creditors? Seriously, guys, it's a very fundamental question. Debtors is somebody okay, I am not responding to that. I'm not taking any sides there. Debtors versus creditors. If you owe money to somebody, they are your creditors. If you owe money, if somebody owes money to you, they are your debtors. So that's the difference. One where you owe money to, another where they owe money to you. My father is in his 50. Can you please suggest investment options for monthly income? Tulsi, there are lots of choices, including even in mutual fund, they have something called MIPs, which are monthly income plan. Then there is RBI floating rate bond. Then there is annuity plans. You need to, okay, I know. So some mutual funds, some categories of funds can have risk. That main category, Ismail, in that is, it was called credit risk fund. As the term says, it was inherent with it is a credit risk. So you have to understand that part of it. What are the ways to avoid tax? I wish the question had been rephrased. You never avoid tax. You can do tax planning. Don't avoid tax plan. So various sections provide you all kinds of tax advantages, like section 80C, section 24. Go and take the help of a financial advisor to do your tax planning. Is it good to invest in foreign markets? See, it's called geographical diversification. All right, it's called geographical diversification. To some extent, you can do it. Personally, I think India is the growing market. I would stick to India. My personal opinion, but people do want to have a bit of geographical diversification. How should I start investing? Like, first of all, do first your financial planning, then find a good financial advisor for you to start your investment journey. Should there be too much dependence on credit cards? You should not. Personally, Mohak, if you ask me, I would not touch a credit card. The day debit cards came into picture, I threw my credit card out of the window. Unless, people do some kind of a planning, like up to 1 month you can spend and not pay interest. People try to do all the trick, but why would you want to do it? I don't want to do it. So credit cards, no, not for me. Should there be too much dependence? Oh, that's done. Okay, then okay, question: should we invest in gold bars? I live in Dubai and purchase a lot of gold for sake of investment, but then I have doubt that I'm doing it right, or should I go for SGB gold? I purchased, don't have. Okay, all right. So let me answer the very good question there. Of course, the gold cheaper there in Dubai. Leaving that aside, on a generic way, gold in a liquid form is better than gold in physical form, because we keep it in physical form. You look at safety, and then if it is gold ornaments, then making charges and the wastages, etc., come into picture. Gold, if you're looking at investment, I would suggest SGB or gold ETFs, now, or gold bonds. Now, sovereign gold bonds is interesting because they pay you a 2.5% interest on your invested amount, and when you finally get it at the end of the period, the profit you make is tax free. There is no capital gains tax on it, as long as you keep it till the last. Like, I think it's 8-year lock-in or whatever it is. That way, SGB is attractive. But then if you're living in Dubai and then you're getting gold cheaper there, then you have to look at that part of it. All right. If you're investing in India, I will suggest SGB, bit in SGB, partly in gold ETFs. SGB doesn't have liquidity, but tax benefit. ETF gives you liquidity. You can buy anytime and sell anytime. Okay. What are goods and services tax and income tax? Okay. I'm not answering this, Yasin. I think people are digressing from the basic topic. Okay. Mohak says, thank you. You're welcome, Mohak. Any other questions? Okay, I'll go to the chat. I think there are some questions in the chat. No, if Satyam, if you get out at 5 years, you don't get the capital gains benefit. Only if you keep it till 8 years, you get the capital gains benefit. Annuity bond, insurance companies offer you the annuity bonds. I don't call them bonds. Annuity, they call annuities. They are not bonds. Okay. Any other questions? Okay, you're welcome, guys. So I think now there. Thank you. Okay. Okay, Rajani Kant again. Kindly guide with accessibility to generate yearly income. Okay. Okay. So that's for Yasin to take note. That one. Rajani, I'm sorry I missed your question. I'm going to answer your question. If you need regular income, there are funds called balance funds or MIPs. Okay. So you should look at those kind of mutual fund schemes. But kindly go and reach out to a mutual fund distributor, give your goals, and they will suggest you the right kind of fund.
I think we are reaching the end of the session.